From the morning reading, the Dow and the S&P 500 hold the 200 lines. After a wild week, stocks closed high enough on Friday to hold their 200-day moving averages. Dow Industrials climbed 211 points on Friday to end above its 200-day line. The S&P 500 doing the same. The only problem with the price gains saw the lightest trading of the week. That doesn't show much conviction. The New York Stock Exchange Composite Index also bounced but remains below its 200-day line. The New York Stock Exchange needs to clear the resistance line and its June low of 10,900 to improve its short-term picture. The 14-day RSI for the New York Stock Exchange bounced from oversold territory near 30, but its MACD lines remain in negative territory. Short-term oversold conditions no doubt contributed to Friday's bounce. All three stock indexes found support at their March low, but remain well below their 50-day lines. It remains to be seen if stocks can build on those gains next week. A lot will depend on whether or not stocks in China and Europe can hold onto their late gains. Speaking of the 200-day moving averages, the percent of New York Stock Exchange stocks above that key support level showed some improvement this week, but remained low. Shows that the percent line falling below the 40% earlier in the week to the lowest level since last October. That earlier market correction took the red line down to 30% before turning back up again. That percent line jumped to 45% this week for a 5% bounce. The negative divergence by the percent line and the New York Stock Exchange Composite remains a concern for the health of the market. In other reading, traders have been so hesitant to hold positions overnight that the S&P index has gapped up at the open on 6 of the past 10 days, one of the tightest clusters of large gaps since 1982. That's usually a good sign for forward returns, but it was volatile. Smart money hedgers went net long approximately $4.5 billion in index futures this week, the third highest of the bull market. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:50 a.m. Central Time, and I'm recording this in preparation for the market day of July the 13th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's dive into our overnight report. And we did have news out of Greece. It looks like they may have a settlement. If they do have an agreement, that should be positive for markets all the way around. You see all four of the broad market U.S. markets are up. And indeed, quite a turnaround. The ES at one point, I think, opened down 20 points, and to be up now 13 at the time of this cut, that's a 33-point move in the overnight action. So again, following this trend of very large gaps and even overnight trend changes, and that's even more perhaps unusual. We have it up about 2/3%. The Russell more bullish at about 3/4%. NASDAQ even more so at 0.82%. And the Dow, the least, well, I would put it right in there with the ES, up about 2/3%. Crude oil down about 0.9%. Euro down about 0.5%. Bonds down about 0.5%. And gold, perhaps the least moving of the indexes that we follow, and it's down about 0.25%. China continues to build on its recent strong surge. It picked up in the last couple days about 10 percentage points. Its overnight is at 2.37%. Hong Kong 1.3%. Japan 1.5%. Germany 1.3%. And the United Kingdom about 0.5%. In terms of macroeconomic reports for today, you have only one yellow flag report, the federal budget balance. So nothing really to speak of there. This Greece talk will definitely dominate the action for today. In terms of tomorrow, we have core retail sales, business inventories, that looks to be about it for the beginning of the week for the U.S. markets. In terms of volatility conditions, obviously we continue to kind of bounce back and forth with headline risk primarily contributing to the volatility. We did put in a standard deviation move across all 4 of the indexes on Friday, and that was a positive up move, so that's for many people the best kind. IV percentiles 35, 35, 35, 51. So all those coming down somewhat. Short-term VIX also falling down to a 17.24. You see skew less than 120. Everything really kind of ebbed off on Friday and became a little bit more normalized. If this holds today with this initial up move, we could probably see many of these values further normalize. The standard deviation moves, we had the big 3 standard deviation move that's almost ready to age off almost 2 weeks ago, and then we've been followed by a couple recent ones. Still overall a little bit below normal in terms of volatility, in terms of achievement from one day to the next, from one close to the next. That doesn't say that intraday volatility certainly hasn't been of note. Indeed, if you look at the SPX in recent days, I mean, we've had a lot of intraday movement just to end up nowhere. And I think the last week we ended up with just literally just a handful of points away from the week open to the week close. If we go to the weekly candle, we can see that probably better. So yes, indeed, you ended up with this big old doji for the weekly candle. That's the kind of stuff that reversals are made of. So it'll be interesting to see if this little breakdown from the prior range and then even broke down through a level below that, if that ends up being the current low, and that we bounce back up into this former range and take this risk off from having fallen through these key levels in this last week and so. So we'll see where that goes. Let's take a look quickly at some of the others. Russell, very similar action, but these are pronounced, weak trends, but the question is can they follow through the beginning of this week and basically put an end to that breakthrough to the bottom side. NASDAQ, very similar pattern here. And Dow looks very much like the S&P. Bonds, I suspect, will get crushed today. And let's see what we're doing so far. So far, yes, indeed. Bonds down pretty handedly. And, we may see bonds break down below this level of support that's been put in of late, with this Greek euro crisis being apparently resolved. You notice that bonds were still seen as safe haven when people were truly fearful, but as soon as they were no longer fearful, that price action, left the bond market. And then, of course, transportations have been just in an absolute free fall down. We'll see if that starts to reverse as well. So some pretty interesting things that have gone on as we've tried to resolve these current situations. In terms of the daily report, it's still pretty weak. We still have this as phase 5, the break of diagonal and horizontal support. It still remains to be seen that we break back and set a higher high and a higher low. We haven't done that yet. IBD status remains uptrend under pressure. Accumulation distribution for the S&P a C, the NASDAQ a D. GMI index has improved a little bit. It's gone to a 3 out of 6 with a sell signal still, though. So a lot of weakness being shown here on the stock charts, decision points scoreboard. Not a lot of green there, and really only the NASDAQ in terms of intermediate trend is holding up with a green arrow. Everything else here you see is at best neutral for its short to intermediate trends. The intermediate term market posture, mildly bullish, basically first day bullish. This has been flip-flopping back and forth, so you have to take this with a grain of salt. We need to see some real confirmation of price action, and these are as weak a bull setting as you can get. The S&P just above 20 at 21.6, the Dow 22.5, NASDAQ 20.2, and the Russell 21.2, so cannot get any weaker and still be called a bull. In terms of position sizing, still calling for 50% position sizing given the current investor position sizing opinion. From a volatility standpoint, that one is calling for probably a 75%. I should have looked that up and changed that. I think our VIX has dropped below 18, so that probably is at a 100% size. In terms of hedge warning status, we're at a 2+, red lights, and risk is still elevated, but certainly seems to be coming down. We've had some 3s here of late, but would seem to be coming down, and certainly we've taken it down to a 2+, could easily fall further if we get more confirmation this week. From the volatility standpoint, market and decline warning flashed on Friday. The VIX squeeze, of course, has fired long and is now losing momentum, so that would seem to be a plus for the market. Distribution day count is also falling. We have 5 on the S&P and 4 on the NASDAQ. Nothing scheduled to roll off on that anytime terribly soon, though, so it's likely to stay at that level here for a few days, unless we add to it, of course. Volatility ratio warning also came off. VIX phase, are we falling? Perhaps. Seems to be coming off of the recent highs on the VIX, so that would also be a positive for the market. We have in the new highs, new lows, fairly tame values on Friday there as well. On risk aversion indicators, all 5 are still risk off, though some may be showing some signs of starting to roll up off the bottom. Have not come close to crossing over yet, but some improvement perhaps being seen in the risk aversion indicators. And the special opinions, option income strategies, VIX is inside the acceptable window, but technically volatility conditions are acceptable. At the same time, we're dealing with this hedge risk level 2, so we've got to be wary and certainly consider the potential for increased risk and certainly increased volatility. Covered call, novice traders should probably not be initiating new positions quite yet. Wait for confirmation on this action that it actually holds, that we actually get a higher high and a higher low. We've not achieved any of that yet. Aggressive traders may start to dip a toe in the water. And certainly a 1-to-1 distribution between in the money and out of the money strikes would seem to be appropriate. In terms of put selling, conditions are not acceptable for new core put portfolio positions, but aggressive traders could be putting some toes in the water. But consider put credit spreads with defined risk and consider scaling into positions until the market has confirmed a stronger bullish posture. In terms of the relative rotation graph, we see some signs of improvement. We were seeing an awful lot of negative tails here before, other than the regional banks. Regional banks were doing pretty well, but that was the only sector that was green, the only one that was showing that pattern of going from lower left to upper right that you want to see. Though maybe starting to see some action here. XRT, that's retail, XBI, biotech, starting to show some signs of improvement and maybe starting to become more suitable for investment. Sector market postures, pretty much a Christmas tree at this point. We started to see some improvement here, more green coming in with Friday's action. We'll probably see if this holds today, this significantly improve. Consumer discretionaries, healthcare, staples, retail, and we kind of saw some evidence of that up here as well with this biotech, this regional banking. Some of those are the sectors that we're probably going to see become healthy first. As a percent change, obviously green across the board for the 1 day, but keep it in context. Look at the 5 day, look at the 1 month, 3 month, year to date. This has been a very, very difficult market for follow through for going on 7 months now. So keep yourself with conservative position sizing until conditions improve and become more consistent. That should be enough for today. If you find this helpful, greatly appreciate your liking us on YouTube and retweeting us to your Twitter followers, and the same kind of action on StockTwits, etc. Always appreciated. More information about how we apply these principles is available at this website. Disclaimers as always. Hit the pause button to review if you need more time. And we'll look forward to seeing you back here before the market open tomorrow morning and the market preview. Thank you. Good trading.